channel. As you know that I am Rosa Rawat, and today we are going to learn something amazing, extraordinary and exemplary. Yes, so we are learning trading. As you knew that we are continuing chapter 2, if you don't have listened chapter 1, so please go ahead. And yes, my course name is The Bible of Complete Stock Market, Basic to Advanced Level. PhD Investor and Trader, and the author is Nandan Singh Raut. You can find this book on Kobo, Kindle, Amazon and Flipkart. So what are you waiting for? Just go and buy. So let's continue our topic. Just give me 1 second, guys. Okay. And let me just take a pen. Add a pen. So chapter 2, Dow Theory and its rules. About Dow Theory, this is a little bit summary about Dow Theory. Dow Theory was developed by Charles Dow in the late 19th and early 20th centuries, although he never formally documented his ideas. His theories were complied and expanded upon by his successors, William Peter Hamilton, Robert Rehay, and E. George Schaffer. Charles Dow was the co-founder of the Wall Street. Just remember that Charles Dow was the co-founder of Wall Street Journal and created the Dow Jones Industrial Average, DJIA, short form. Whose short form? Dow Jones Industrial Average in 1896. He used stock market movements to analyze economic trends, forming the basis of what is now called Dow theory. His editorials in the Wall Street Journal laid the foundation for modern technical analysis. Now, we have a bit summary. If you want to read, I can just cut all and you can, yes, of course you can take the screenshot. I hope it's done now. So, we just move ahead for the 6 rules of Dow theory. The 6 rules of Dow theory. I don't know what is happening. Go to my screen. Okay. Rule number 1. Market discount everything except act of God. It also defines trend. Repeat with me, guys. Market discount everything except act of God. It also defines trend. Now let's see what it says. There are three trends: uptrend, downtrend, and sideways. So you just can see the pattern uptrend. How is uptrend looking? like a one big slanting and this. This is called uptrend. And this is called downtrend. Uptrend and downtrend are very easy. And sideways are also very easy. You just have to see the patterns. Like this is a sideways. Right? Yes. Everybody listen. Soon I will open the chat so you can ask questions. Now here you can see the full pattern, like how will it work. Uptrend will go like this. Higher highs and higher lows. Can you just tell me who are higher highs and which one are the higher lows? I think yes. If you have said that higher high are these, so great. And if you are saying that higher lows are this, yes. Now you will ask that how I know that. And now you will ask, that's why, because you can see here higher highs. It's becoming in high and they are being pointed on highs only. And why higher lows? Why not lower lows? There are no lower lows because it's not going to downtrend. It's going to uptrend. So that's why higher lows. Understand, guys? I hope you understand. In sideways, these are the sideways as I told you. And now downtrend. Downtrend pattern is like this one is lower highs. What are these? Lower highs. And what about these? Lower lows. Now why have, did you think that why have put in lower highs? Not, why not lower lows? That's why, because this is making lows, right? The pattern is going downtrend, but the pitch is on high. The pitch is on high, not here. That's why. I hope you understand, guys. Okay. Uptrend and downtrend and sideways. Not sideways. I hope it's bimetrically wrong. Rule number 2. Rule number 2. Now the rule number 2 is the market moves in trends. As I told you guys that 90% of market goes in psychology. Yes, psychology. It defines the structure of market in form of wave. Stock prices do not move randomly. They follow distinct trends. Dow identified 3 types of trends. Now, if you have seen patterns, any patterns in trading, so what do you see? We think that randomly any pattern has came. No. First, you have to see previous. When we give a child results, think that if I am a teacher or you are. When we give anybody the result in exams, so we look everybody's previous things like this is indisciplined, this was studying, this is a good person, it is kind hearted, and so on. Same in this, you have to look for previous. You can't put randomly anything. They follow discipline. They follow distinct trends. We have to look the previous one. Right? Yes. Like somewhere any pattern is be given and it can't be that any pattern. Maybe without wig. If you have given the dozy candle and a one body on your body. No wig. So something is wrong. There is to follow distinct trends. The same way. Now, Dow identified three types of trends. Dow identified three types of trends. The first type is primary trend. In short form, we can also call long term. We have heard many times that do you have to do long term or short term? Long term or short term? Same. You can also call primary trend is equals to long term only. Long term movements that last for months or even years. 1 year or more. Not any 1 year. It could be more because it's a long term. What is a primary trend called? Long term. That's why. So it could be 1 year or more. These can be bullish, rising market or bearish, falling market. Sorry guys. Secondary trend. Have you understand this? I hope. Secondary trend. You can also call the secondary trend intermediate trend. Intermediate trend is also medium trend. So you can also call medium trend if it's hard word. Medium term corrections that occur with a primary trend lasting from weeks to months up or up to 3 months. These are often temporary pullbacks or rallies. So you can see that in primary trend we have seen that the movements can also go till 1 year or more. Yes, it can also last for months, but it can be go for 1 year or more. In secondary term, we see that for the corrections that occur with a primary trend lasting from weeks to months up to 3 months. So, because it's a medium trend. Secondary trend you can also mean. So, that means that in medium, in short term you will see like up to weeks or something. That in primary trend it's a long term. For the intermediate trend it's up to 3 months. Yes, it can last for also weeks. I hope understand. And these are often temporary pullbacks or rallies. Minor trend. Minor trend. Short term trend. Now what happens in short term price fluctuations lasting from days to weeks up to 3 weeks. These are small movements that do not impact the overall trend. 1 second, sorry. I want to make something, that's why. Whoa. Okay, can you see here? Yes, here. It is fluctuate in type. It's a little bit like glitching. It's a little bit like glitching. Now, I hope this is for lasting from days to weeks up to 3 weeks. These are small movements. These are all small movements. So what happened in trends? So whatever happened in trends, it do not impact, means a little bit small, means this much or this much. Up to this much you can say, up to this much only. So it doesn't impact the trend, the whole trend it doesn't impact overall. That is the point. Excuse me everybody. Now here you can see the pattern. Here you can see the market trends. Now all the three. Primary trend will be shown to you, secondary trend and minor trend. Minor trend is in black color and secondary trend is in red color and primary trend is in green color. So can you see? It's a very long line. So what it should be? Yes, primary. This is also a primary. If we not see the colors, you just have to see the mention the lines. How many big are there? So obviously they will be primary trends. And if you will see, means primary trends last 2 months or 1 year or more. Now here secondary trend. Secondary trend lasts 2 weeks to months. Now here you can see the second trend. It's a little bit like medium, so it's okay. It's a little bit medium, yes? Yes. And here if you can see the minor trend, these are very small, so it doesn't impact on, yes, on the whole overall trend. And how many last it weeks? Last from days to weeks, up to 3 weeks maximum. These are small movements, do not impact overall trend. Now let's go with the rule number 3. If you are all good in this, so yes, just remember, practice make a man perfect. If you want this whole course, so you will get this whole course in the Bible of the Complete Stock Market Basic to Advanced level. Rule number 3. The market has 3 phases. How many phases? The market has 3 phases. Each trend consists of 3 phases. This will be our last rule, and the last 3's 4, 5, 6, rule 4, rule 5 and rule 6 will learn tomorrow. So here you can see first accumulation phase. You can say first phase of a trend. The accumulation phase is the beginning stage of a trend, where experienced investor often call Smart money. Start buying or selling before the general public notices the trend. So I hope this was easy, so you can understand this one. So no need to understand you. Second point of accumulation phase. If accumulation happens after a downtrend, it signals a bullish reversal, uptrend beginning. If accumulation happens after a downtrend, like something like this, this is a downtrend. I'm not making the zigzag patterns or it will be not clear to you all. And this is the accumulation phase. If accumulation happens after downtrend, yes, it signals a bullish reversal, uptrend beginning. If accumulation happens after the downtrend, this is downtrend. So and this is the accumulation phase. So what it signals? This signals that it would be the bullish reversal. Now this will go with uptrend beginning. Something so on. Now if it happens after uptrend. Third point, if it happens after uptrend, so it may indicate continued growth or just a temporary pause. If accumulation happens after uptrend, so it indicates that it may continue growing or it just take a temporary pause. Temporary means a small pause, means for a little time zone. Now let's come with the consolidation phase. A period where stock prices move sideways within a narrow range. This happens when buying and selling pressure are nearly equal, often before a breakout or a trend continuation. So this will look like this is resistance and this is support. When I will say that this will be only made in support, so this is support on here. So it couldn't be in the between or here. So the consolidation phase, like later will selling from here, or yes, you will see some green patterns, little green patterns, and equal if we do here, so you will see some patterns going through here. Yes, this is red one and this is, it will cut from here. This will be the red one, this will be the green one. It's not compulsory. This could be also green or this could be also red. But you will not see the whole green or whole red. Little bit of red in green, you will see little bit body of red. Means it could be a little bit small or it could be a little bit big. And in green also, you can also see a little bit small or a little bit big body or with a wick also. I hope you understand. So, nearly equal, often before a breakout or a trend continuation. Now, let's go with the distribution phase, the final phase of an uptrend. Yes, where informed investors sell their holdings to less experienced traders, leading to a potential downtrend. Now, first of all, let me show you the picture if it is given. I hope it is given. Yes, it's given. Just give me 1 second, guys. Well, we can't see this, so that's why I need a little bit. Stickers. One second. Okay, sorry, but can you just look like this? Let me first be like slanting too. So here you can see the downtrend. If it could be like this. Can you just see the distribution phase downtrend? I'm really sorry for this. Can you see here a downtrend pattern? Oh. This is a downtrend starting new phases of market. And I think this is not start from this, it starts from the, okay, this starts from this one. So here you can see that this is going downtrend. Okay, so that's why lower lows, lower high, a pitch. That's why lower lows, lower highs, and lower lows. This is an accumulation phase. As you can see, this is an accumulation phase. This is a participation. This is consolidation. This is also participation. I can't look now, besides that's why I have a bit problem to write and all. Yeah. This is also participation, and then this is a consolidation. This is also a participation. Distribution phase, as I told you, consolidation will have equal parts. Like this is green, this is red, green, red, green, red, green, red. Same to distribution. And then downtrend, starting new phases of market. Now this rule 4, it defines that indices must confirm each other. I will tell you tomorrow. Thank you for listening to me. And yeah, if you want this thing, so you can also get this in the Bible of Complete Stock Market. Let me just show you some pages that you will just think that this is all the real. Just give me 1 second, guys. See what we learned today. The uptrend. Am I right? Rule number 2, rule number 3 and all. This is all copied from this chapter. Yes, I just want to teach this. Oh. Phases of market. Right now we were learning. See, this is a downtrend, and this is the accumulation phase. This is a participation, consolidation, distribution, and then downtrend and starting phases of market starting. Okay, this is the volume. So, and tomorrow we will gonna learn it defines that indices must confirm each other. So yes, if you want the full course, you will get in this. Even though I am also teaching, but yes, if you want to confirm all the things, as a book is a good friend for everybody. Right? Is this a true thing? Book is a good friend. So yes, bye bye for today.